Kicking us off to the close here on this Friday afternoon is Julie Biel, portfolio manager and senior research analyst at Kayne Anderson Rudnick. And there's a lot of questions right now, Julie, about how much exposure you want to this market, given some of the uncertainty still with regards to what's happening in the Middle East. But I also just kind of want to just add to that mix the idea that some of the softness we have seen in this market over the past few days is also being compounded by concerns about private credit, concerns about AI, basically concerns everywhere right now. And yet you have a market that is down, but certainly hasn't necessarily fallen off a cliff. Kind of wrap that together for me.
I think it's really a function of the different components moving in very different directions, right? So it's a little bit this metaphor of the duck looking pretty tranquil and pitter-pattering underneath, right? And we've seen that kind of, especially through this earnings season of companies, and the reactions that we're seeing in the stock movements are really large to the upside and the downside. It's regularly 10%. And so what we're seeing overall, if we're looking at the index level, is something that looks quite placid. But if our individual owners of shares, it's been pretty volatile and pretty painful. I think that what we're really seeing is we have so much liquidity in this market that always produces a lot of natural support. You have so many young people who've never lived through a really persistent bear market as an investor, who really believe buy the dip will always work out because it always has. And then you have all of these underlying concerns that for us older folks really do bring up a lot of the old memories of the GFC. When we're starting to talk about CLOs again, I mean, I thought we were done with those, no?
Apparently not. They're back, Julie. In all seriousness, though, I do just want to get your thoughts on just the idea of investor sentiment and the idea that when we came into this war, there was a lot of folks who were kind of dismissive about the impact on financial markets. Obviously, there's a human toll and all that. But the impact on financial markets and how history has shown that energy shocks tend to be relatively short-lived in terms of their economic and market impact. But of course, it's been 2 weeks of this, and we still have not seen the supply routes, at least coming out of the Persian Gulf, open back up. Is there a point that you look at where you maybe do start to worry about this?
Yeah, I think that the issue that we have is when we're talking about the Strait of Hormuz is that the long-term impact is that it's not going to be resolved, even if we kind of declare ceasefires, that it's going to take time to unwind that. And I think the clock is really ticking on whether or not we're going to see interest rate cuts. And I think if oil remains really, really high, it's going to put a lot of pressure on the U.S. consumer. Most of that is going to get blunted by the impact of the One Big Beautiful Bill and the tax refunds. But that will run out. That will eventually run out. And I think there's a real concern that that bleeds out and creates a much weaker consumer and a lot of negative sentiment that already kind of existed.
And Julie, I'm curious, if you put this into the stock market, how does this change your thinking about how you want to be structuring a portfolio right now? The idea that, the consumer could be very vulnerable here. It depends a lot on what happens with, of course, oil prices and interest rates. But how do you sort of invest around whatever base case you might have?
Well, I think it's a nice opportunity to be able to look at the price action and recognize that the underlying themes of many businesses are still quite strong, quite robust. The earnings outlook still looks pretty good, even at higher oil prices. I think that you really have to be fixated on quality right now. The speculative, narrative-driven stories that you see in quantum and biotech are not a good place to be in right now. And I think it's interesting, right, to see after all of these concerns, all of these cute creative writing projects telling us that the death of software was imminent, it's suddenly we're seeing people coming back into software with renewed enthusiasm. And it makes sense to me, right? These are businesses with high cash flows, high returns on equity, all the stuff that we're told is an important part of a balanced portfolio.
Right.
And I think those are the types of businesses you should be looking at.
So I was going to ask about software because I'm taking a look at your notes that you sent over to our producers. And one of the bolded sections you have is that good software companies are like a pretty woman. It's hard to look away. And I was wondering what that meant, but it sounds like it means you're bullish.
Yeah, I mean, it depends, right? I think I would not be bullish on buying the IGV writ large because I do think there are some real existential risks to software. The type that's used for just pure optimization, I think, is fertile ground for any kind of AI disruption. You need to have some proprietary data sets, some regulatory barriers. Those are the types of kind of quality businesses that I think are going to be better insulated.